Hi everybody, Investing Club here. In this video, I want to go over what I believe to be the most undervalued stock in the entire stock market right now, and one of the most undervalued stocks I've ever seen. I think this stock is... And so before we get started with the video, be sure to hit the thumbs up button for the YouTube algorithm. I appreciate all the support. And now let's get right into the video. Now, before we get into the video, I want to talk about something. And that is, I have not seen a single video on YouTube covering this stock. And I want to talk about the reason for that. This stock is not some obscure small cap stock that nobody's ever heard of. This stock's in the S&P 500. It's a large cap stock, or at least it was until recently. But for some reason, when I search it on YouTube, there's no videos for it, even though this is clearly severely undervalued. And what is the reason for this? Well, the truth is, YouTubers that talk about stocks on YouTube don't actually talk about stocks that make good investments. They just talk about stocks that are popular and will get them views on YouTube. I hate to say that, but it's the truth. When you have the most popular finance YouTubers talking about investing in Tesla and Uber, you have to ask yourself, are those even good investments? And for me, those stocks aren't investments, they're speculation. And I just feel bad because when beginner investors go on YouTube and find these people that talk about Tesla and Uber and all these other speculative stocks, and they put a lot of money in there in those stocks, and then inevitably the stock's going to go back down. The Tesla's stock at $900 is not sustainable. It's pretty obvious it was going down from there. And what's going to happen are all these new investors are going to lose all their money, and they're going to be the exact people that say you can't beat the market picking stocks, and the stock market's rigged, and you can never make money in the stock market, right? And that's just not true. It's just that you listen to the wrong people. So now that I got that little rant out of the way, without further ado, let's get to the stock I am talking about. The stock I want to cover today is Alliance Data Systems. Now, this stock is a provider of loyalty and marketing services. They have a large percentage of retail clients. They provide the loyalty cards for these stores. So if you ever go to Lowe's and have a Lowe's loyalty card or a CVS loyalty card, this is the company that is providing them to those stores. And in addition, they provide marketing services and mine data from the transactions of these cards. And this was a stock I talked about in one of my past videos. And I was talking about how it was undervalued at $100. And now the stock is all the way down at $30. So to me, this just presents an incredible buying opportunity, the likes of which I've never seen before. Now, I'm on Fast Scratch right now. And anyone who's watched my videos knows I like to use this website. What I want you to notice is this orange line represents the earnings, right? How much money the company's making. And what I want you to see is, even though the stock price has been going down, the earnings have still been increasing. They had one down year this year from 2018 to 2019, but the forecasts earnings are expected to continue growing. Everyone knows earnings are expected to continue growing. The stock price has just fallen off a cliff. This company is normally traded at a PE ratio of 18, and if it ever returned to that, this is a $300 stock currently trading at $30, which means to return to fair value, the stock would have to 10x, which is just incredible. We can go to the forecasting, and if we want to return to the normal multiple by the end of 2022, we would see an annualized return of 138% per year, which is just incredible. Now, there are a few risks with this stock, and that's what I want to talk about first, because you don't see a stock that's this cheap when there's not some risks, or at least perceived risks. So I have a few here. One, they recently named a new CEO. He started in February 2020, and I actually like this move. Even though typically I like management teams that have been with the company a long time and have shown a track record of success, I think this CEO change is the right move for the company. The previous CEO was really running into some problems, and I don't think knew how to solve them. Meanwhile, Ralph Andretta has a lot of experience in the credit card industry, and he worked with Citigroup, American Express, and Bank of America. I think this is the perfect person to lead this company in the future. And one last risk is that a lot of their credit card receivables are from mall-based retailers. All retailers stocks have been, beaten down badly, and there's a lot of talk about a lot of these companies going bankrupt. But what I want you to notice is this company has been shifting to e-commerce, which is a booming industry, beauty products, home goods. And so now 60% of their accounts receivable are in these new industries that won't be hurt if the retail industry continues to suffer. Now, the second risk they have is a lot of debt. And this scares a lot of people. It concerns me because, as I've said in previous videos, looking at companies with a lot of debt is not ideal in a time like this where the entire economy shut down. But what I want you to notice is this company is in a very good position. They raised an additional $850 million in unsecured notes. And the CEO recently put out a conference call talking about how the company is in a great financial position. Now, they don't have any debt due until 2022. So they are able to ride out this storm uncertain times where they might not be earning much money. And they still are gushing operating income and free cash flow. I want to bring you to FinViz right now, and the first thing that jumps out at me, price to free cash flow is at a 1.6, which is just incredible value. This company gushes free cash flow, which is something that I love, okay? In addition, their price to cash is 0.3. So what this means is they have more cash. We see right here they have $79 in cash a share, and the stock is at $28. Right, every single sign points to this company being severely undervalued. Now, their dividend is 8% right now, and the thing is, their free cash flow covers their dividend. We can come back to fast graphs and look at their free cash flow, and their free cash flow is just incredible. It covers their dividend by a very wide margin. And so even though, of course, it's going to decline, there's such a huge margin here that I don't think they're going to have to cut their dividend. And honestly, this is a company that's so cheap. If they had to cut their dividend to help pay off debt, I wouldn't even care, because this company has the potential to go to $300, which is a 10x. I don't care if they have to cut their 8% dividend. Now, in addition, we can take a look at Simply Wall Street. And we can see here they had the special call update their shareholders, which I think is always good. The CEO is taking proactive steps to talk about what actions they're going to be taking in the future. Now, Simply Wall Street has the fair value pegged at around $100. So, even if the stock price returns to this, that's over a 3x increase. So even being super conservative and looking at this valuation, it's just insane value to be had right here. Now, the financial health, what I want you to note is, even though they have a lot of liabilities, their short-term assets cover their total liabilities. And their short-term assets are things like accounts receivables and the like. So their assets aren't something like buildings or machinery where they don't really help much. They are actual future cash that will be returned to the company to help them pay off their loans. And their debt, as we can see here, their debt is covered by their short-term assets. Their dividend yield is 8.12%, which is just a very good dividend, especially in this environment. And the crazy thing is, there's a good chance they're not even going to cut the dividend. In addition, their payout ratio is only 22%, which indicates that it could grow even more in the future. There's been insider buying in the past 3 months. Every single sign is pointing to this company being a great investment. And this is a big thing right here. Institutions own over 95% of the stock. The general public owns only 1.7%. And so I think a big reason for the stock price dropping from over $300 to down to $30 is because institutions have just been dumping the stock, and there's really been no one in the general public to be able to buy it back up. I think the sell-off is almost over, and after that happens, the only place for the stock to go is up. Now, some final thoughts about this stock. During the 2008 to 2010 crash, this company did not lose money. Their earnings per share fell about 30%, which is to be expected. But, as a credit card lender, that's very impressive when most financial companies just were, just a flaming mess during that time. They have had positive earnings per share every year since 2001. They only have a conservative level of debt, which is only at around 2 times debt to EBITDA. And they throw off tons of free cash flow, which I talked about. So that's pretty much it, guys. Let me know what you think of this stock pick in the comments. This is one I'm buying, plain and simple. I'm looking to buy. it might go down a little more. If this stock got down to $20, that would be incredible. Again, leave a like on this video if you like the fact that I'm bringing you stocks that no one else on YouTube is talking about, and really no one in general. These are stocks that are not well known by the general public and have the opportunity to make you incredible returns. Subscribe to the channel if you haven't already. I'm on the lookout for stocks like this constantly that are severely undervalued. And with that, I hope to see you on the next video. Bye-bye.